Economic data seemingly a little bit better than expected from the Conference Board's gauge of U.S. leading economic indicators. The Philadelphia Fed read on manufacturing, also a bit of a support there for the equity trade. But for instant reaction to the LEI leading economic indicators numbers, we're turning now to Ken Goldstein. He's economist at the Conference Board itself, the group that puts forward that economic indicator itself. The street seems surprised, the number coming in stronger than expected.
A little bit stronger, but in actual fact, in some sense, the more important number here is not the leading index, but the coincident index, which for the first time since last October, actually did not decline, was zero. And that's the measure that tells us where the economy is right now. So at least as of July, the declines in the economy were no longer continuing. Here's what's really important in all this. If you go back to last February, last March, almost everything was down. Now it's more of a mix, which is what's giving us this number in terms of the coincident index, with the leading index telling us this number is going to turn positive and probably soon.
You are referring there to the ratio of coincident to lagging indicators?
No. The ratio of coincident to lagging is sort of the shadow lead, and both have been moving up for the last 4 months. But this is the first month that the coincident index, which tells us where the economy is right now, did not decline, first time in almost a year. And
that is key to calling a bottom.
Absolutely. And so, and then you get the sense that, this call, are we still, or are we going to be out of recession soon? Even if we're at a recession, this is going to be very tough going for a period of time, perhaps another 3 to 6 months before we move into robust growth. So that for the consumer out there, and especially just hearing that job claims just went up again, this is sort of like, who cares?
Right. Yes, saying the recession potentially has bottoms or that there's a bounce back doesn't really mean anything when you don't have a job. So what's that, we've talked about the negative feedback loop in terms of the financial sector. What's the impact there when you see a jobless claims number like that to relatively positive data?
Well, but if you look at this jobless claim number, it kind of explains why these back-to-school sales in August didn't really, set any house on fire. And perhaps a signal here that the coming holiday season is not going to be all that good, even if we're at a recession.
Even if we're out of a recession at this point. So
no, even if we're out of recession by the time we get to the holiday period.
By the fourth quarter.
Right, so that consumer spending, probably will be a little bit better than now, but not that much better, and certainly not if the labor market, in terms of employment, in terms of jobless claims, are still, so weak.
There's been a lot of focus on those jobless claims numbers, on unemployment more broadly, and the sort of lack of visibility into the reality of whether people are just no longer searching for jobs because they've been unemployed for a certain amount of time, that there's not necessarily a real accurate picture of the unemployment levels out there. What's your gauge here?
Well, I mean, certainly we're hearing about some people who found a new job, but that's few and far between. We're still hearing, and will still hear for a couple of months, far more about people who just lost a job or who are afraid of losing a job. There's one more point to make in all of this. Even if the unemployment rate's 9.5%, that means that 90% of us still have a job, but about 90% of us think that our paychecks are not keeping up with inflation, even though inflation's still low. That, too, feeds into this overall sense about where the consumer is, and it's crucial to the question not about whether the recession can end, but about whether it can be about whether the expansion can be sustained.
So this July gain in the LEI that we brought you at the top of the hour marks the longest series of increases since 2004, but big caveat there.
Well,
Thank you.
Oh, sorry.
Thank you so much, Ken Goldstein of the Conference Board. Thank you so much for joining us on set with that breaking news.